Welcome back to the deep dive. The world of finance often feels like this c- complex maze, right? So much jargon, so many numbers.
It really can be intimidating. Seems designed to obscure sometimes.
Exactly. But what if there was a simpler tool, something powerful that gives you a shortcut to understanding a company's value?
Ah, you must be talking about the PE ratio.
You got it. Price to earnings. It gets mentioned constantly. Analysts throw it around. But what does it really tell us, especially for listeners who already follow the markets?
That's the key question. It's fundamental, sure, but the insights go way beyond just a definition.
So today we're going to unpack it. Definition, calculation, the different kinds, and crucially, how to use it well, and maybe when not to rely on it too heavily.
Right. The goal is to give you a really clear, actionable understanding, more than just the textbook version.
Yeah. If you've ever wondered how analysts actually compare companies or what makes a stock price high or low in a meaningful way, stick around. We should hit some aha moments today. Okay, let's dive in. What is the PE ratio? Like at its absolute core?
At its core, it's actually remarkably simple. It's a comparison. You take a company's current share price and you compare it to its earnings per share, the EPS.
Okay, share price versus EPS.
Yeah.
And that helps gauge what exactly? Relative value.
Precisely. It helps determine the relative value of a company's shares based on its earnings power. It gives you a snapshot of market valuation.
Gotcha. And I often hear it called the price multiple. Why is that term used? What does it signify?
Well, it's useful because it literally tells you how many dollars investors are willing to shell out right now for just $1 of a company's earnings.
Ah, okay. So a PE of, say, 20x means.
It means investors are essentially paying $20 for every $1 of that company's current earnings. It directly reflects market sentiment and, importantly, expectations about the future.
And those expectations can point in different directions, right?
Right.
A high PE isn't automatically bad.
Not at all.
Hmm.
A high PE could mean the stock's overvalued, sure, maybe it's gotten ahead of itself, but it could also signal that investors are expecting really strong growth down the road. They're willing to pay a premium today for those anticipated future earnings.
Right. Betting on future performance. And conversely, a low PE.
Same deal, multiple interpretations. It might suggest the company is undervalued, maybe a bargain relative to its earnings,
Potential opportunity.
could be. Or it might just mean the company is in a stable, mature industry with less exciting growth prospects, so investors aren't willing to pay a high multiple. It's rarely black and white.
That nuance is so important. Okay, but what about when you look up a stock and see PE listed as NA? No earnings, obviously. But what's the challenge for an analyst then? Say, for a new IPO or a startup burning cash.
Yeah, NA means no positive earnings to calculate with. You can't divide by zero or a negative number here. The challenge for analysts then becomes shifting gears.
So,
They have to move away from earnings-based valuation, at least temporarily. They'll lean more heavily on other metrics, maybe price to sales, or even qualitative factors.
like what?
For a new IPO, they'd be scrutinizing projected revenue growth, total addressable market, the management team's track record, maybe patent strength.
Mm-hmm.
It's about valuing the potential, because current profitability isn't there yet.
Makes sense. So let's get into the mechanics. How do we actually calculate it? The formula seems simple enough.
It is. PE ratio equals market value per share divided by earnings per share.
Market value per share, that's just the stock price. Easy enough to find. But the EPS, that can be tricky, right?
The-
Past earnings, future earnings.
That's exactly where the two main flavors of PE come into play. Trailing PE and forward PE. Each gives you a different perspective.
Okay, let's break those down. Trailing PE first.
Right. Trailing PE is the most common one you'll see. It uses the company's total earnings per share over the previous 12 months, often called TTM trailing 12 months.
And the advantage there is,
Objectivity. It's based on actual reported numbers, stuff that really happened.
but the downside?
Well, as we know, past performance doesn't guarantee future results, and stock prices move constantly, while earnings only get reported quarterly.
So it can lag behind reality.
It can, especially if something significant happened to the company recently, a big acquisition, a major setback. The trailing PE might not reflect that new reality yet.
Okay, so if trailing looks back, forward PE looks ahead.
Exactly. Forward PE uses estimated future earnings. These could be the company's own guidance or estimates from Wall Street analysts.
The pro seems obvious. It's forward-looking, tries to capture growth expectations.
That's the appeal. It incorporates what investors think might happen.
But what are the potential pitfalls here? What should an informed investor watch out for with forward PE?
Well, the main pitfall is that it's based on estimates, not hard facts. Projections can be wrong.
Uh-huh.
And sometimes companies might, let's say, manage expectations downwards with their guidance, making it easier to beat the estimate later. That can distort the forward PE.
Ah, the expectations game.
Precisely. Plus, different analysts might have different estimates, which can lead to conflicting forward PE numbers for the same stock. So you need to know whose estimate you're looking at. Requires a critical eye.
Okay, so you have these two types. What's really insightful, I think, is comparing them directly for the same company. What does that tell you? Like, if the forward PE is lower than the trailing PE.
Ah, that's a great tell. If the forward PE is lower, it signals that analysts are expecting earnings to increase in the future.
Right, because the denominator future earnings is expected to be bigger.
Exactly. So today's price looks like a smaller multiple of those higher anticipated earnings. Conversely, if the forward PE is higher than the trailing, it suggests earnings are expected to decline.
That's a quick, powerful signal about market sentiment right there, just comparing the two.
It really is a snapshot of the expected earnings trend.
Speaking of trends, let's add some historical context. The PE for the whole S&P 500 has swung wildly over time, hasn't it?
Oh, absolutely. You saw lows around 6 times earnings back in mid-1949. Then it rocketed up to 122 in mid-2009, right after the financial crisis when earnings collapsed if prices hadn't fully followed.
Wow, 122. That's extreme. And more recently, as of June 2025, it was around 29.46.
That's right. And when analysts want to look at these really long-term valuation trends across whole business cycles, they sometimes use things like the PE10 or PE30.
Okay, what are those? Different from a single company's PE.
Yeah, they're market-level metrics. They average the S&P 500's earnings over the last 10 or 30 years, often adjusted for inflation. It smooths out the short-term bumps.
So it's less about valuing one stock and more about...
More about understanding if the overall market looks expensive or cheap compared to its own long-term history. Gives you that broader economic context.
Fascinating. Okay, we've got the theory down, but the PE really comes alive when you use it for comparison, right? Let's make it concrete.
Absolutely. Comparison is where its power lies.
Okay, let's take an example. FedEx, FDX. As of August 8th, 2025, its stock price was $228.05. Its trailing 12 months EPS was $16.81. Do the math.
$228.05 divided by $16.81. That gives you a PE of about 13.57.
14.57. Okay, there's the number.
Yeah.
But standing alone, it doesn't tell us much, does it? How do we give it meaning?
Exactly. You need context. You need comparison. Let's stick with that same date, August 8th, 2025, and look at two energy companies.
Okay.
First, Marathon Petroleum, MPC. Stock price $160.84. Diluted TTM EPS $6.88. That works out to a PE of 23.38.
23.38 for MPC. How did that compare to the market then?
At that moment, the S&P 500's trailing PE was roughly 24, so MPC was slightly below the overall market average.
Got it. And the second energy company?
Let's look at Hess Midstream, HESM. Stock price $41.64, diluted TTM EPS $2.69. Calculate that.
$41.64 divided by $2.69 comes out to about 15.48.
Right, so you have MPC at 23.38 and HESM at 15.48, both in the energy sector.
So comparing them directly, MPC's PE of 23 versus HESM's 15, the simple take might be that MPC looks overvalued relative to HESM, right? Higher multiple.
That would be the surface level observation, yes. But this is exactly where you need to dig deeper. It's not always that simple.
What else could be going on? Why might MPC command that higher multiple?
Well, several things. Investors might expect much higher earnings growth from MPC compared to HESM. Maybe MPC's refining business is seen as having more upside potential than HESM's midstream infrastructure.
Or maybe different risk profiles.
Could be. Perhaps the market sees MPC's diversified assets or capital allocation strategy as superior, justifying the premium. Hess Midstream might be viewed as more stable, predictable cash flow, but maybe less growth.
So the PE reflects all those underlying assumptions and perceptions about the business models.
Exactly. It's a starting point for asking why there's a difference. It forces you to investigate the fundamentals driving those market expectations. That comparison highlights why a single ratio never tells the full story.
Beautiful example, and that leads us perfectly into the crucial part, the limitations. When should we not use PE, or at least be really careful?
Okay, the absolute golden rule, the biggest limitation. You should only use PE as a comparative tool for companies within the same sector.
Right. Comparing, say, a software company's PE to an oil driller's PE.
Is basically useless. It gives you an uncogent conclusion, as they say. Their business models, growth rates, capital needs, accounting practices, they're just too different.
Yeah.
A high PE might be perfectly normal in tech, but a huge red flag for a utility. Apples and oranges.
Critically important point. And we mentioned it before, but worth repeating. If a company has negative or zero earnings,
PE is NA. Can't calculate it, can't use it for valuation. You need other tools.
what about debt? How does that complicate things?
Debt can definitely skew the picture. A company might take on a lot of debt, use that leverage to boost its earnings per share temporarily.
Making the PE look lower, more attractive.
Potentially, yes. But that lower PE comes with higher financial risk because of the debt load. The PE ratio itself doesn't show you that leverage risk on the balance sheet. You have to look beyond it.
Good point. And there's also an element of trust involved, isn't there, with the earnings data itself?
Absolutely. The price is public, set by the market. But the earnings comes from the company's own reporting.
So you're relying on them being accurate and honest.
You are. Analysts and investors have to trust that the company's officers are providing genuine information. If earnings are somehow manipulated or misrepresented, the PE ratio becomes misleading, potentially dangerously so. Due diligence is key.
So the takeaway is PE is vital, but it's just one piece of the puzzle.
Precisely. It doesn't capture everything, future growth potential in detail, debt levels, the actual quality of those earnings, intangible assets. It's a central data point, yes, but never the only one you should look at.
Okay, so if PE is a great starting point but has limits, what other metrics help fill the gaps? Where else should investors look?
Well, one direct relative is the earnings yield.
Ah, yes, the inverse. Tell us about that.
You just flip the PE ratio, it's earnings per share divided by the stock price, usually shown as a percentage.
And why is that useful?
It's helpful if you want to directly compare the return you might get from the stock's earnings relative to, say, the yield on a bond or other investments. It frames it as a rate of return.
Interesting. Can you calculate it even if earnings are negative?
You can, actually. You'd get a negative earnings yield, which, while not intuitive as a yield, still allows for comparison, especially with those growth companies that might be losing money currently.
Okay, useful for comparing across asset types. But what about that growth factor we keep mentioning? PE alone doesn't tell you if the valuation is justified by expected growth.
Exactly. And that's where the PEG ratio comes in. Price to earnings to growth.
Right. How does that work?
You calculate the PE ratio as usual, and then you divide it by the company's expected earnings growth rate, usually over the next year or few years.
So it explicitly links valuation to growth expectations.
Correct. It tries to level the playing field. A common rule of thumb is that a PEG ratio below 1 might suggest the stock is undervalued relative to its growth prospects.
Price is low compared to the growth you expect.
Yes. And a PEG significantly above 1 might suggest overvaluation. The price might be too high, even considering the expected growth. It adds that crucial growth dimension, very popular for analyzing tech or other high-growth sectors.
Makes sense. So PEG is a key one. Are there other quick alternatives worth mentioning?
Definitely. Depending on the industry, others become more relevant. Price to book, or PB, is one.
Comparing market value to the company's book value from its balance sheet.
Right. Very useful for asset-heavy industries like banks, insurance, manufacturing, where tangible assets are a big part of the value.
Okay. What else?
Price to sales, PS, stock price divided by revenue per share.
We touched on this great for companies without profits yet, right? Like startups?
Exactly. High-growth tech, early-stage biotech.
Yeah.
If there are no earnings, PE is NA, and maybe book value isn't representative, PS lets you value the company based on its revenue generation, its top line. How much are you paying for each dollar of sales?
Got it. One more.
Maybe enterprise value to EBITDA or EBITDA, a bit more complex, involves enterprise value, which includes debt.
And compares it to earnings before interest, taxes, depreciation, and amortization.
Yes. It gives a more holistic valuation picture, especially useful for comparing companies with different debt levels or tax rates, or in capital-intensive industries where depreciation is significant. It strips out some of those financing and accounting differences.
Excellent. So quite a toolkit beyond just the PE.
Absolutely.
Yeah.
A good analyst uses multiple tools.
Okay, let's wrap this up. We've really unpacked the PE ratio today. We've seen it's a quick, pretty powerful way to gauge valuation, especially when you're comparing similar companies in the same industry.
It really is a foundational metric, offers valuable clues about market sentiment, relative value, investment prospects.
But as we've stressed, it has limitations. It's never the whole story.
Never. It has to be used alongside other financial metrics and, crucially, with an understanding of the company's specific context, its industry, its growth, its risks.
Right. So here's something for you, the listener, to think about. The next time you see or hear a company's PE ratio mentioned, maybe in the news or an analyst report, will you look beyond just that number?
Will you pause and consider its industry, its growth prospects, maybe check its debt level? Think about the potential for earnings quality issues.
How might understanding this tool, with all its strengths and weaknesses, change the way you analyze financial news or how you think about a company's true potential?
Something to ponder.
Definitely something to ponder. Thanks for joining us on this deep dive.